Good evening, everybody. This is a subcommittee meeting of the Subcommittee on the Environment and Flooding. I'd like to have the clerk please call the roll.
Chairman Samaras?
Here.
Councilor Elliott?
Here.
Councilor Noon?
Yeah.
3 present.
Thank you. We're here tonight to try to provide information to many of our constituents who are concerned, especially about flood insurance and the issues that deal with FEMA and the federal government. And we have Emily here from one of my former favorite students from Lowell High School, here to introduce some people from FEMA, correct? And first of all, does any member want to say anything? Councilor Elliott?
Just a couple words, just for the people at home. As the chairman mentioned, this was a motion that I had filed to give those residents that are that have property and homes in the floodplain. The maps have been updated, and consequently, so has the method that FEMA uses to assess or evaluate risk, and consequently the impact that has on the homeowner insurance policy. So I think the timing is important. If there's an opportunity to let people know about the system and contacting their, and I'm not really sure, and this is why we're having the meeting. Is it the insurance? Isn't the insurance agent? Is there a clearinghouse? So that was the intent of the motion. So I think this will be helpful for the people that are affected and that are required to have flood insurance.
Thank you, Councilor.
Thank you, Mr. Chair.
Thank you. Councilor Noon, do you have?
No, just want to thank Emily Byrne from the Congresswoman Trahan's office and to organize this so that FEMA can be here to give us, some of the common or answers to some of the concern that resident of Lowell, particularly Pawtuckaville, has had on the flood issue and flood insurance. So I appreciate that. Thank you.
Thank you. And correct. And Emily, I should have said your complete name, Emily Burns. I mean, I know you're the lead person for Representative Trahan, but I remember when you were at Lowell High School, I think you were in my office every day giving me some very good advice. I want to thank you for being here. I mean, I know you have the best interests of everybody at heart, so could you please introduce the group that you have? And
well, thank you, and thank you for the opportunity. I'm honored to be here on behalf of Congresswoman Trahan, who wishes she could be here with all of you tonight, too, but unfortunately she's in Washington, D.C., doing important work. But as Councilor Elliott said, Congresswoman Trahan is following up on the City Council's request to invite representatives from FEMA to meet with the subcommittee here to explain the National Flood Insurance Program and the Risk Rating 2.0 Equity in Action that took effect on October 1st, and to ensure that all of our residents here in Lowell understand the flood zones and can take advantage of this pricing and methodology rating system. So Congresswoman Trahan is grateful for FEMA's willingness to join us tonight and for their continued partnership, especially over these past 2 years. I know it's been tough for all of us, but FEMA has been doing Herculean work. So thank you for your partnership. And we're honored to have representatives from FEMA Region 1 tonight, including Bob Desaulniers, John Grace, Dave Mace, and we also have Daisy Sweeney, and additionally, also our counterparts from the Commonwealth here, we have Joy DePrault. So I'm going to turn it over to John and Bob to walk through a brief presentation, and then they'll be able to take some questions. Thank you.
Okay, this is Bob. Can you hear me okay?
Yes.
Okay. Let me just first do a quick overview on the program itself, the Nfip program. Basically, it's a partnership between the government and the communities. We refer to the program being kind of best described as a three-legged stool. Communities join the program, and in order to be able to get flood insurance for their property owners, they agree to adopt certain minimal floodplain management ordinances. And then floodplain management is one leg of the stool. That's all about the community and their floodplain ordinances and joy in the state overseeing things. And then there's the leg of the stool that's involves identifying the risk, which is that's the FEMA maps. So our flood insurance maps are really the responsibility of FEMA, working with engineers and standards to come up with a map that a community could use to identify kind of the universal standard for high hazard flood exposure has been the elevation that a flooding event would go to if it were the 1% flood event chance. So in other words, a flood event that has a 1% chance of occurring on an annual basis. That's not just the United States. That's the whole world kind of uses that 1% event as the benchmark to kind of identify, take a look at the topography, take a look at the water sources, and come up with a map that represents areas where if the 1% flooding event happened, to what elevation above sea level would that water rise? And that, if you imagine a picture of a map, in certain areas of the map would be in the color blue. That would mean that if your house in any way impinged on that blue area, then you would be considered in a high hazard flood zone. Inland, that would be a flood zone beginning with the letter A is in alpha. So Congress established the Nfip in 1968, and that three-legged stool, the last leg was the insurance. So the original intent was the leg of the stool, which was providing insurance, was kind of the carrot in order to partner, with the government. And you willingly adopted to be a member of the program, adopted floodplain ordinances. Then the community property owners were entitled to be able to get flood insurance through the National Flood Insurance Program. So that basically is how the program has been structured since the early 70s when it became functional. Along the way, there have been some changes. One of the most notable was in the 1990s. Congress created a law that applied to banks and lenders, and it basically said that if any loan that you give is backed by the federal government,
John, did we lose Bob?
Hey, Bob, we're losing you. Why don't you try turning your camera off?
yeah, okay, let me try that. Okay, can you still hear me?
Yes.
Yep, that's good.
Okay, and so any rate, that element came in the 1990s where people, kind of had no choice. If you were in a high hazard flood zone, or the property you were buying, the building was in a high hazard flood zone, then the bank would make you get a flood insurance policy. And for the most part, our product, the Nfip, was the only available one. So that's kind of the background, and we've had Lowell's been in the program for a significant amount of time. John, next slide. Yeah, right now our latest numbers show that there are 922 flood insurance policies with the Nfip that are in Lowell. Now, this does not include private flood insurance. Agencies are, in fact, selling private flood insurance. So there's probably more, in most of the private flood insurance policies are acceptable to the banks. So there's probably more than 922 policies, probably closer to, over 1,000 when you consider private flood insurance. Next slide. The equity part of describing risk rating 2.0 as an action that to bring more equity maybe one of the most important changes that is coming with or has come with risk rating 2.0 involves older homes. Under the original program, going back to the 70s, the program was set up so that if your house was built before the community had a flood map, and therefore there was no guidance, and basically houses built before the 70s, the early 70s, all fell into that category. The program gave them very much discounted premiums. And also, a lot of the premium, the basis for establishing premiums had to do with the elevation of the house and that 1% elevation above sea level where that flood would go. So, trying to be fair, they said, okay, these houses that were built when there were no floodplain ordinances, no guidance, we will not use, we'll give them a lower premium, but we will not require that they submit an elevation certificate or be rated using the actual elevation points of the building. So at the beginning of the program, that was a pretty good deal. And for New England, where, we have a solid 40% of our housing stock is these older buildings, that worked out really well. Around 2012, when the Bigot Waters Reform Act came in, it was kind of the beginning of our having to recognize that the program was losing money and that we could not continue to give that full subsidy to the older buildings. So since 2012, for example, in Lowell or any place in Massachusetts, a building that's in an A zone, so it's mostly a riverine or lake type exposure. The premium now has risen to it's slightly over $4,000 a year for full coverage, and that. Let me just. And that. I'm sorry, and that's been really difficult to deal with. Certainly, the property owners and people like me that try to help them out. So, risk rating 2.0 is actually going to, without somebody paying $800 or $1,000 for an elevation certificate, we're coming out of the dark ages. We're actually going to start using technology that the insurance industry in general has already been using. And we can establish basic elevation points on practically 99% of the homes. And this is done based on LIDAR records that USGS, has really developed over the years. And it's built in that address and the longitude, latitude of the address, that goes into an algorithm. And the basic topographical elevation is included, as part of the premium. And what's happening is that as a lot of the older homes, clearly built before say 1972, when they get their first renewal under risk rating 2.0, 2/3 of them, or maybe even more, are going to see a significantly lower premium than what they're paying now, because it's actually differentiating one building to the next, and it's actually factoring in, elevation data and distances from water sources, etc. So I'm absolutely thrilled about that aspect, because New England has so many older homes, and there's going to be much more equity in the premium that's developed because of risk rating 2.0. The fact is that if you're a house that was built after the community had a floodplain ordinance, at some point, you might have had to have purchased an elevation certificate when your contractor was building the house, if it was determined that you were in a high hazard flood zone. Some communities accept more, data from an engineer other than the elevation certificate. But now, even the newer homes, we won't necessarily rely on the elevation certificate. And I will say that for those people that have older homes that have already purchased an elevation certificate, and it's on file with the insurance company, it can be used. We can manually look at elevations and determine if the elevation certificate might produce a fairer premium. That's kind of an ongoing development that insurance agents, we're trying to educate them to the role of elevation certificates in the new risk rating 2.0 program. They have not been totally eliminated. Next slide. Yeah, there's some really basic differences in the two programs, and probably the key thing is the old program. When I first came into the program, 12 years ago, it was pretty archaic. The variables that were used to develop the premium were very much weighted towards what was the elevation of your lowest floor, especially if you had a basement that, most of the homes in New England have basements. So that the lower your lowest floor was relative to that elevation point where we thought that the 1% flood event would rise to, the premium would be higher. We took into consideration foundation type. If you were built on an enclosure, premium might be higher than, say, built on a slab on grade. And then what flood zone you were in was a major factor, based on the Fema Maps. The new premium methodology uses way many more factors. And it relates more to the individual building rather than FEMA's flood maps. What it's looking at as variables are the distance to the water source, the type of, if you're exposed to a river or a stream, the type of stream or river it is. It's also going to look at a different type of flooding. The pluvial flooding is low topographical areas that tend to get flooded when we have rain inundation. That was not considered on the current FEMA flood maps. So we had sections where we paid out lots of claims. They were not in high hazard flood zones, but they really had a flooding exposure that wasn't being picked up by the FEMA flood maps. We're focusing on ground elevation. What is the ground elevation, at that front door of the house? That's what we call the first floor height. The construction type and foundation type, we've really simplified that, and that will benefit insurance agents that have really gotten confused by the program. But for instance, you would, if you describe the building as one that has an enclosure or a basement, it's probably going to have a higher premium than describing a building that's, built on a slab, etc. But what we've also taken into consideration is where our legacy system was based on what your exposure was to the 1% flooding event. The new model takes into consideration every type of flooding, including rain inundation. It actually is pulling in 2 or 3 catastrophe models that are used to, determine the type of flooding and what type damage. It's much more in line with how insurance companies rate policies now. For instance, we will never not have flood insurance maps because that is an absolute necessity for a community to be able to do floodplain management. There has to be a demarcation line so that they'd be able to identify that a building might be subject to the 1%, flood event. And that's usually, what's in their ordinances and how it's built. None of that is changing with risk rating 2.0 at all. Similarly, and we might repeat it later, that mandatory purchase law I talked about, that's not changing. If you are in a high hazard flood zone, the lenders, before they finalize the loan, they do have to do a flood zone determination. And if you are in, they will tell you need a policy. What's going to be different is that this system focuses on the actual building's exposure. So I describe it sometimes to people that it's a micro approach, which is a fairer insurance premium because it's based on the actual exposure that building has. Flood maps are a macro approach. They're absolute necessity for floodplain administration that you have areas and demarcation lines. When it comes to the mandatory purchase law that banks have to comply with, they still will have to look at the FEMA flood insurance rate maps. And if you're in a high hazard flood zone, beginning with the letter A as in alpha or V as in victory, they will force you to buy flood insurance. What's not changing? Statutory rate caps on annual premium increases. So for the people that will see an increase in premium, there is a Congress passed in their last reform that no renewal policy will increase more than 18%. So that's still in play. They also, when we change maps, properties, buildings that are being mapped into a high hazard flood zone for the first time get a reduced premium because that's legislated. That will be part of this program too. The thing that they're also keeping that's really, really important to the property buyers, especially baby boomers, somebody who's selling their property who might be benefiting from this glide path that we talked about, where the true premium that they're aiming to under risk rating 2.0 might be higher, but the glide path of the 18% cap is in effect on that policy. They can transfer without our permission. They can assign that policy to the buyer. And that buyer, if they had gone to an insurance agent and got a quote for flood insurance as if they were going to be a brand new customer, there would be no choice. If risk rating 2.0 or higher premium, that's what they would have to pay. But insurance agents and real estate agents, we're trying to educate them that, when somebody is selling their house, if they have a flood insurance policy and it's going to be subject to this glide path, it's much, much better that policy be assigned, voluntarily to the buyer. So that's still in the program. We mentioned the use of the FEMA flood insurance maps for mandatory purchase of flood insurance by the banks. That's not changing. That's still going to be in place. The availability of discounts, such as the community rating system discount, they'll still be part of the program. There'll be other discounts that, if you elevate your building, there's a discount built into that if on piers, piles, and posts. If you do have a basement or enclosure and you move the machinery and the equipment up above the first floor, you'll get a credit for that. If you have an enclosure or basement and you add venting to equalize the pressure in a flooding event, there'll still be a credit for that. Next slide. Okay, this is the countrywide impact of premiums as policies go over to risk rating 2.0. Later on, John might have a slide that in Massachusetts, actually 39% of our policyholders will see a lower premium. And the simple explanation of that is that we have more older homes that are being rated without elevation, paying that premium of over $4,000, and hopefully they'll see a significant reduction when their policy gets renewed under risk rating 2.0. Most of the other increases, based on a monthly basis, are manageable for most people. Will probably still be an issue for people that have affordability issues right now. But it's Massachusetts, because we have so many older homes, we'll have way more policies that'll see a lower premium. Next slide. Yeah, one of the things that they did with risk rating 2.0 was to do away with the, I used to, I don't mean this to be critical of my own entity there, but, you know, we actuaries are very much driven by trends and numbers, et cetera. So that under the legacy, I'll call it the legacy program, what we're using before risk rating 2.0, we could charge premiums as high as why. There is one policy in force right now, and it happens to be in New England, where somebody is paying $45,925 every year for a policy that's only providing $250,000 worth of coverage. Under the risk rating 2.0, there, you know, for residential risks, you know, there'll be a cap. The most that anybody will see as premium for full coverage would be $12,125. Now that's a lot, but we have policyholders along the coast in Massachusetts that, you know, pay in premiums significantly higher than that. So there'll be some fairness in that. There's also, and I think we covered it on another slide, but I'll mention it here now when it comes to affordability too. Private industry under homeowners insurance. This is my 54th year there being in the insurance industry, working for insurance companies. But a long time ago, we recognized under homeowners insurance, not flood, but homeowners insurance, that a high valued house, most claims on homeowners policies are not total losses, they're partial losses. And a high valued house, when it has a partial loss, it costs a lot more to replace everything than it does on a lower valued house. So there were, we used to call it the U curve, where the premium would be a little bit higher as the replacement cost of the building went up, because partial losses, you know, create that foot of water in a high valued home creates a lot more damage than a foot of water in a less valued home. So this program, it's not going to be like an incredible difference or anything, but there is a skew. So the lower the replacement cost of the building, there'll be a little less premium charged than under the current or the legacy system. And as the value of the building goes up, so even though our limit of coverage is only $250,000, that impact of partial loss and what that does on loss payouts versus premium taken in is still a big factor. So from the affordability issue, by recognizing, you know, that higher valued homes, you know, create larger payouts and maybe moving some of that premium up, it creates a little lower premium on lower valued homes. So that's just something worth mentioning. Next slide. This is a very confusing slide, but they wanted to make the conversion from our current system to risk rating 2.0 initially, while everybody was going through the education process, as painless as possible. So it starts as of October 1st, 2021. Let's talk just about people that already had policies, right? If their policy renews on October 1st, 2021 or later, their policy is going to be renewed using risk rating 2.0. However, if that generates a higher premium than our current legacy system, they will get the lower premium. That is going to be how renewals will be handled up until the last renewal that will, you know, have that advantage of getting the lower premium from either of the risk rating or the legacy program ends March 31st of 2022. So as of April 1st, 2022, renewal policies, it'll be what it is. It'll be renewed with risk rating 2.0, and and that'll be the premium. So, from my perspective, and kind of really knowing, how everybody is impacted by the new rating methodology. Between October 1st and April 1st, there'll be a bunch of people that, basically the only ones going to risk rating 2.0 are the ones that are going to benefit premium wise. So it'll be, when we get to April 1st, it'll be all the renewals will be converted over and rated using risk rating 2.0. Now that's renewals. Now, if you did not have a policy with the NFIP as of October 1st, 2021, any quoting of NFIP policies for brand new business that's been going on since October 1st, 2021, the insurance companies that represent us, should be just quoting using the risk rating 2.0. So I'm not getting a lot of feedback on that, because our renewals are just like regular homeowners. This generally isn't the time of year that people are buying houses and having to get flood insurance, etc. Again, we'll probably get a better picture of how this is going to work out as we get more into the spring. So next slide. Yeah, this is just a quick one. This risk rating 2.0, is not 100% product of FEMA and our people in our headquarters, because private industry had really taken an interest in writing flood insurance. And they were using techniques and modeling and, that we really, hadn't used. We were still in the dark ages. So what we see as a final product, using algorithms and everything else that private insurance companies have been using already, those were all recommended to us, by various segments. They're listed there: IA Insurance Service Rating Office, catastrophe entities like AIR. Millman is a major consulting company for insurance companies, the major insurance companies. So we had a lot of input as to how this risk rating 2.0, should look and feel. And this is day one, so it could change as we move along and get results and get feedback. Next slide. Yeah, so getting back to the affordability, because there's been some confusion in the sense that risk rating 2.0 is neither a vehicle to recapture the $22 billion deficit, nor is it the vehicle that's going to introduce some sort of affordability framework that earlier legislation calls for. So Congress, has our report on what our recommendations were from our study as to, people that do not have resources, how and why and where, and how are we going to make flood insurance affordable for them? So that probably will be part of the next reform of the NFIP that Congress does. But because we were conscious, things like the replacement cost of a dwelling and shifting and more balancing with more equity the cost, and the pre-firm, those older, what we call older homes, getting them to see a premium that more reflects the building's actual exposure. A lot of that too was driven by trying to bring equity, into the program. We tried to ensure that all the rates complied with the existing statutes, so no renewals are going to increase over 18%. It actually will be less than 18%, and not to bottle down with detail, but For instance, I have a preferred policy that costs $600. About $170 of the $600 are flat fees. Now, these flat fees cannot be impacted by any of, they're just flat fees. So when we say that the renewal would be capped by 18%, it's not going to include, those flat charges are put aside. So people, who are on this glide path, the good news is that the policy declarations page will show the premium, the full premium that they're headed towards, and it'll then show what they're going to be billed. So they will know whether they're going to be getting this, 15 or 16% increase, for how long. That's not the case in our current program. People who have the older homes, and we keep on talking about them having to submit an elevation certificate to see what the full premium would be. And they'll say, well, how long are we going to keep on getting these? It's $4,000 now. When is it going to stop? The only way we could really tell them when it would stop is if they paid for an elevation certificate, so we could re-rate it with elevation data. So now, being able to focus on the individual building is going to represent some affordability relief for people with older homes. Private flood insurance too. We have agreed, and we are trying to encourage the private flood insurance market to come in, be a player. We basically know that Congress, we kind of help the banks. I know I have, to get them to understand private flood insurance so that they would accept it under these mandatory purchase laws. And some of the private flood insurance policies were maybe half of what we were charging. So, we're trying, under affordability, we're trying to encourage private insurance to step forward. And it's, if you can get the appropriate reinsurance from these big international companies, it's a good way to, you can stabilize your auto and your homeowners, and the fact that you write their flood is why an agent, might keep the account. Next slide. Yeah, I'll hand it over to John now, because you probably heard me drone with my terrible connection here. John will just kind of summarize some of the key points, and and then we can see what questions might be out there.
Yeah, so let Bob catch his breath. In summary, one of the key takeaways here is we're projecting to see that most pre-firm homes, what pre-firm means they were built before they had a map, will see a premium decrease. As Bob mentioned, I can show you the Massachusetts one, which is about, like Bob said, 39% immediate decrease. And then I would say 50% of the rest of the homes will see an increase of up to $120 a year. Now, as Bob talked about, there's going to be a new rating variable, which is going to take into account a lot of characteristics of the actual structure of the house itself, which we didn't do before, as well as the risk characteristics that it's around it. Like Bob said, distance to the flood source, the stream order, which is the type of river it is a little tiny babbling brook versus a huge river like the one in Lowell. Your ground elevation, your first floor height, which is the floor that you walk onto, the construction type of your house, and how often your house or the area floods. Again, no change to mandatory purchase of flood insurance if it's a federally backed loan. There is that statutory rate cap. CRS or any other discounts will not change. You can still pass this this benefit or this premium or insurance policy to a new buyer. And I've actually seen people put that on their advertisement to sell their house. Comes with a flood insurance program. As long as they keep paying it, they'll get that. And we'll still have the FEMA flood insurance rate maps to use for regulatory purposes and floodplain management. And then those required fees that Bob talked about. There's a glide path, which means that if someone is going to have, when they get their policy, they'll see what their house is rated at now. And if there's going to be an increase, It'll show what the full policy cost is going to be in that future, and it's going to show them what it's going to take to get to that full cost of their policy with 18% a year. Now, Bob talked about all those flat fees; those won't be included in that glide path. So it could take a good amount of years to get from where you are to your full risk rating 2.0 policy cost.
Okay. Yeah, anybody have any questions? And I know Emily had mentioned that she'll make our email addresses available if somebody, has something very specific. They can go through Emily and she'll see that we get the questions. But for now, just I know we threw a lot out at everybody. But any questions, let me know.
First of all, I want to thank you for an excellent presentation. I want to thank Emily for bringing this presentation to us. What I was pleased about, it was understandable, because quite often, sometimes when we're talking about insurance and other problems, it becomes so complicated and convoluted that people will not understand it. My own question, Emily, to you would be, is it possible, we're going to make a presentation. This will be presented many times, on TV so people can look at it. And there's a good explanation of what's occurring, what's happened in the past, what will occur in the future. Is it possible to have this meeting either by Zoom or them come in personally to the Pawtuckaville Association? Because I'll tell you, not only people from Pawtuckaville, but other people in areas in the city that, come under the floodplain, or people who have homes at lakes and, on the water, near the water.
We're happy to follow up and see if that's something that we can schedule.
I just asked, I just think this was a good presentation, and this would be well worth to bring it directly to the people.
And I also think we can share this presentation with the Pawtuckaville citizens.
Yes.
And the fact sheet that
Yeah.
they shared.
But their explanations were very clear. The outline's good, it's very good, but the thing is, a lot of people are going to fall under very shades of different meanings. And I think when people see this, they're going to have a better understanding that there are some differences out there, and, what category do they fall into? And the more information you give them, the better off we are. So the thing is, we'll put a request into you at some point to, do we want to make this into a motion?
Sure.
I'd like to make a motion that we ask you to make the presentation to the Pawtuckaville Association, which will also include anybody else from any part of the city.
Sure,
And a
happy
second?
to revisit that and regroup with our friends here at FEMA to kind of coordinate scheduling-wise with the Pawtuckaville City.
And a second from Mr. Elliott, Counselor Elliott. Any questions, Counselor Elliott?
I do have some questions, Mr. Chair, if you don't mind. Could you just describe the difference between a homeowner that is getting flood insurance from a private insurance versus, I suppose, insurance from the National Insurance Flood Program?
Yeah, that private, not every company wants to participate in writing private flood insurance. We call it private because it's not the government, it's an individual company that's choosing to write it. And historically, the companies that do write, not all of them, but a good percentage of them that do write private flood insurance are called excess surplus lines companies. So what does that mean? It means that they're there for lines of business that your, Arbella's and Commerce and the everyday insurance companies, won't write. So state insurance departments allow them to sell their policies within the state because that market is needed. So the downside on a lot of the private flood insurance markets would be that, if they were to go belly up, every state has a fund that if an insurance company goes belly up, that all the rest of the insurance companies will come in and try to still provide the coverage. A surplus lines company, wouldn't benefit, from that at all. But on the other hand, state insurance departments do study the financials. They don't regulate these companies, but they do study the financials. And generally, a company, these companies are pup companies of very large organizations, and they usually have the wherewithal. But what happens is if they write a lot of flood insurance policies in a particular area, I'll just use 2010. Let's say that, you thought Rhode Island was a great state to write flood insurance in, and you wrote a lot of it. With the inundation flooding in 2010 in Rhode Island, it wasn't even the coastal, hurricane. It was just rain inundation. Some of these companies would have been in real tough financial shape, et cetera. So that since 2010, the excess surplus lines market is it's much more healthier. It's backed by reinsurance, but it's still not regulated by your state insurance department. If there were a claim and you didn't like how their adjuster was handling it, you could be an issue. So most insurance agents, I won't name names, one of the biggest agents in your area there that I've done business with for decades, they generally, if the private flood insurance is going to save that customer, it's going to cut our premium in half. And otherwise our customer, has to have the flood insurance and couldn't afford it. And the bank was going to force place coverage, which sometimes their force place policies are even higher than, much higher than our premium. Then that's a good option, for that policy holder to be able to keep flood insurance with a private market, banks happy, and premiums lower. It's just that every year that private flood insurance company, will make a decision to stay in the market. Okay. And as long as where they wrote business, there weren't any major events, they could stay in the market for a long time. But insurance agents know, and state insurance departments know that, that type of a company, they don't even have to, they're not subject to state cancellation laws where if I'm going to non-renew you, I have to give you a 30-day notification. So I'm probably beating this to death there because I'm making it sound.
I thought I had a good grasp on this until I asked that question.
Yeah, but let me put it this way: most of those markets are extremely healthy, and the insurance agents have a healthy respect that they tend to use those markets only when it makes 100% sense for their client.
Okay, so I'm not in a floodplain, so but first I agree with Councilor Samaras. I think you took some very complicated issue and put it into layman's terms, and I concur that it'll be good to present this to people in the Pawtucketville section of the city where there's probably a greater number of people that are affected by this. But if you look throughout the other sections of the city, and I'm thinking, certainly Centerville will be affected, but even South Lowell and the Concord River. So getting the link or even this meeting to those neighborhood organizations, they can play it for, during their monthly meetings. So just as I mentioned, I'm not in a floodplain, so I'm not really familiar with what the process is. If they have a mortgage, if residents have a mortgage on their house, the banks are going to require them to get flood insurance. Where does the National Flood Insurance Program come into play? You subsidize to the insurance carrier or the homeowner, or how does that equation work?
Yeah, well, under the current system, right, our legacy system, the older homes aren't paying as much as they should. The older homes where we don't have elevation certificates to actually determine the premium based on their real building exposure.
Right.
And basically, the current law says that we have to put that subsidy minimally every year. We have to increase those premiums for those older homes by 5%.
How much do you
know-
subsidize? What is that? I guess that's, what is the
Well,
subsidy?
the subsidy basically is when you know that, oh gosh, I mean, I'll do the example that down to my level, I guess, is that you're running you're a kid, you're running a Kool-Aid stand, right? And a lot of your customers are elderly and they don't have a lot of money. So you make a business decision that all these older people coming down the street with, using canes, et cetera, and I can say that I'm 75, but, I'm only going to charge them 5%, which means 5 cents, which means that I'm not making any money at all, but I'm going to charge everybody else, what it costs me for Kool-Aid and water and ice and that sort of thing. So I'm subsidizing, on my product, my Kool-Aid. I'm not charging older folks what, I should be charging them so I can make a profit. Okay. And the program originally was set up in the 70s. I was around then, and it made perfect sense. It made perfect sense. Why? Because a lot of the folks back then, including myself, felt that these older homes, through no fault of their own, now found themselves, in a high hazard flood zone. There was this sense that, that we'd only be subsidizing them temporarily, because they would be totally damaged in future flooding events, or somebody would buy them new and do a substantial improvement, make them into a new building, and then they would, they would have to, be rated using elevation, et cetera. And in New England, we all know that the older homes are probably built better than the newer homes, and that's what I found out anyway. And so these buildings didn't disappear; they're still here. But overall, a lot of them are located along rivers, on shorelines, because there were no ordinances. So a good percentage of our deficit, is actually attributable to the fact that, we don't charge what an actuary says we should charge for these homes, because we were trying to be fair at the beginning of the program.
Okay, so when you say you're talking about, I guess my point of question would be the subsidy. Where does the federal government step in? Where does that money go to? Does it go to the insurance carrier who provides the policy and thereby the premium to the homeowner, or it doesn't go to the homeowner directly?
No, the subsidy is it's if an actuary said this is how much looking backwards, looking in the rearview mirror on all the events and the losses and the flooding events, et cetera. In order for this program to break even, we would need to charge X amount of dollars, right? Because the way the program is set up, that deep pocket subsidy that was allowed for the older homes, we just don't collect the premium that we should. And I know I'm probably complicating it, but the Bigot Waters Act in 2012 said, okay, we can't keep subsidizing the older homes anymore. They're having too many losses. So we're going to have to gradually let the actuaries bring into their premium closer to what the correct premium would be for that particular group. So I guess one way to probably confuse you more, though, but I mean, let's say you were an insurance company and the only thing that you insured was older homes. In other words, you wouldn't do flood insurance for any house unless it was built before 1972. Okay. Then over the years, you would look at their experience and you would keep on adjusting your premium so that you would always get enough premium to pay anticipated future losses based on looking in the rearview mirror, as an actuary does, on what has happened in the past. That company, if the government said to that company, you can't, you have to start off with only being able to charge 60% of what you truly would need, that company would go bankrupt. Okay. The federal government, pretty much by allowing a subsidy back to the beginning of the program under a very sound, we need to be fair concept, we hit the point where in 2012 that clearly, because of the loss history of these older homes countrywide, they demanded that we start charging them more premium.
Okay.
So a complicated way would be to say, oh, we're taking the subsidy away. The easy, more understandable way would be, if you own an older home, is that, gosh, since 2012, my premium's going up almost annually, and by 5%, minimally by 5%. So that's basically, we could be, in order to get all the premium we would need for the experience of that group that we call, the older homes, if we did it all at once, it would be people could not afford the premium differential that would come into the program. So,
That's good.
Bigot
Thank
Waters says, come in and bring that premium back in at clips of, minimum 5% every year.
Great, thank you, Mr. Chair. That's the answer to all my questions.
Quick questions to, thank you, Mr. Chairman, to FEMA representative. With regard to this risk rating 2.0, when does this going to take effect?
I'm sorry, could you repeat that question?
When the risk rating
computer-
2.0 start to take effect?
October 1.
Gosh, I'm not sure if I got your full question. It's not your problem. I got a new computer and.
It's all right, I can repeat it. When is the risk rating 2.0 take effect? You indicated that from
correct.
October 1st to this year to April 1st of next year. But there are
Right.
those,
In other
who
words,
are going to stay with the same policy. Is that correct?
Right. If you certainly, if you already have a policy, you do not want to let that policy, lapse. You want to let it renew and be on the glide path.
Okay.
So any policy that was in force, in place before October 1st, 2021, will be renewed and into the risk rating 2.0, but only up until next April 1st. Any renewals that occur before April 1st, they will always have the choice of the lower premium, the legacy system or the risk rating 2.0. Anything once we hit April 1st, then all the renewals will be rated using the risk rating 2.0, and there will not be an option to go another year, using the premiums from the legacy system.
I see.
Let
Thank
me
you.
give an example. Yeah, okay.
Thank you. So does the private flood insurance require to apply this same risk rating 4.0?
No, they could be using similar things to risk rating 2.0. A lot of these companies they're not regulated by the state, so they don't have to file, insurance manuals to show you how they got to their premium. But let's put it this way. Some of those older homes we just talked about,
Right.
that we were charging $4,000 or more.
Right.
A lot of them were the ones who were buying private flood insurance. Private flood insurance, created a market for those type buildings where they might charge $2,000 where they knew that we were charging, $4,000. Those private markets, they're looking at risk rating 2.0 too, because if all of a sudden our premiums, are significantly lower for a particular building, let's say that our premium used to be 4,000 under our legacy system, and the private company quotes 2,000. Now, when we go to risk rating 2.0, let's say our premium goes down to $2,000. The insurance agent has a dilemma because does he move the policy back to us? Because, at least we got a guaranteed coverage and you know exactly what you're dealing with. It's that will happen. And so, by our being fairer, I was in the private industry for, including now, 54 years. So I was in that position where I had to decide, what type risks I wanted to write as an insurance company. And one thing about flood insurance that's attractive to these companies is that the premiums usually are much higher than homeowners premiums. There's a little meat to the premium. So, they think it's a pretty good deal to write a flood insurance policy in an A flood zone for $2,000 because that's for their market. That's a pretty high premium, and to be able to cut our premium in half, that's their selling point.
I see.
Now, the insurance agent is the one that really, it's a difficult decision because if under our legacy system, that person was benefiting from some sort of grandfathering rules and the insurance agent, move them to the private market so they could save $1,000 a year. And then the following year, the private market just turns around and says, we're going to do something different now. We're not doing flood insurance. Then the agent and there'd be a gap in coverage. And when he went to put them back with the NFIP, it would be a significantly higher premium than they had, when they were with us. So private flood insurance is it's risky, but it's the premium savings for somebody that otherwise couldn't afford the flood insurance and would be at the mercy of the banks to force place it. It's a good option.
Thank you so much. You have a lot of very good information. I like just from your presentation alone that we can see that the risk rating 2.0 is going to be some things that looking at many factors that have not been looked at before. I think it's incumbent on us as a city to share that with our homeowners who live in area that being affected by flood to balance it out between going with the private insurance or stay with with this kind of program. So thank you very much. Thank you, Mr. Chairman.
Yeah. Could I add one thing to that too? The insurance agents are the key to all this. They're getting a better understanding and feel for the new program, and I'm as much concerned with trying to have insurance agents fully understand this. At some point, for instance, Lowell's insurance is probably, workers' compensation, your fleet and everything is probably insured through one insurance agent in town. Okay. At some point in the future, besides the actual property owners, I'd be more than willing to talk about, put me in contact with that one agent that makes a lot of commission from the city of Lowell's business. And you have leverage on that agent, and you can say to that insurance agent, gee, can you work with FEMA to understand this program better? So, that all the agents in Lowell, you'll never catch all of them, but, have one lead agent that one of their goals to help the city out who they benefit from because they provide your insurance and get commission is that you tell them, to keep our business amongst a million other things we're demanding. We want you to, understand this flood insurance program better. and you can work with FEMA directly, or with, we'll set that up. So at any rate, I don't want to, I always talk when I convert an insurance agent, so that they really, and I do that every week, some agent that kind of the light goes on and they get it, then that affects hundreds of his clients, okay? But most of my time on the phone is spent with individual property owners, and once I fix their problem and get them the best deal, they're gone. I mean, they're happy, but so I myself personally, I would love to leverage the city's relationship with their insurance agent community. So you wouldn't have to do any extra work or anything, but I mean, just leverage that you talk with the insurance agency that provides most, the Lowell's fleets and workers' comp and everything, property and, city building, fire insurance, blah, blah, blah. Put them in connection, with people like myself, with John, so that we can, and you can say, listen, one of the things we would like you to do as the city's insurance agent is to, you get to know this program better, and then help us educate other insurance agents in the community, even though they compete against each other. So it's just a thought I'd throw out there. I think it would help people like me.
Thank you. One final, any more questions, Councilor? Councilor Noon addressed some of the issues that I wanted to raise. It seems, though, with somebody obtains private insurance, that insurance company can decide at the end of the year that they no longer want to be in the business of flood insurance, or it's like hurricane insurance, or whatever. And people sometimes are left, without insurance. And sometimes, from some of the investigations I've had, I've talked to people who've had agents that will say, an agency that's out of New York, out of Washington, out of Baltimore, or something. So it's all telephone calls and what have you.
Right.
Now, an insurance company leaves them, a private insurance. How quickly can FEMA react to meeting their needs? I mean, it's.
Yeah, we
I've
can.
seen people have shown me letters where they received and said, we're no longer insuring you because we feel that you're in such a high-risk area, therefore, have a nice time. We might try to help you obtain an insurance company, but.
Yeah, some of them only give a 5-day notification.
Yeah.
And well, here's the thing: is that the our program for very basic insurance principles, we have a 30-day waiting period, and there are lots of exceptions to that 30-day waiting period. But usually, you can get flood insurance with an immediate effective date from us. If you're financing, or you're refinancing, or we change the maps, but for somebody that they have a private flood insurance policy, and all of a sudden, they get the 5 days and the policy is canceled, there's going to be a problem in that if they don't have a mortgage, so that the issue does not involve, whenever the reason they have to have the flood insurance is because there is a bank who has to, comply with that law. If there's a mortgage company and they were accepting the private flood insurance, and now the private flood insurance disappears overnight, the agent can get the insurance from us practically the same day. However, if you're a baby boomer and you bought the private flood insurance because you felt that you were kind of in harm's way and it was a good price, when you're given that short notice, then to get our policy, you'd be subject to the 30-day waiting period. And the reason we do that is the same reason that homeowners companies, when there's a hurricane coming up the coast, everybody would buy a flood insurance policy, and as soon as it passed, they would cancel the policy. So the 30-day waiting period kind of protects the program from people who would, buy the policy at the last minute, and then, it's called adverse selection, and no insurance person, likes to have their book of business have a lot of people that only want the insurance when they're in imminent danger.
Thank you very much. Councilors, any further questions? Emily, we want to thank you, and the people from FEMA, we want to thank you for an excellent presentation. And as we stated, we have a motion to perhaps bring this to, first, to the Pawtuckaville Association, to have allow people to be able to ask the same questions that we were able to ask tonight. I want to, again, thank everybody, and any further discussion?
No, I concur. Thank you to Congresswoman Trahan's office, Kara, Keefe, and Elliott for being here. I know it's kind of mundane information, but for the people that are affected by it, this is significant. I think this is significant information that, as Councilor Noon mentioned, it's incumbent upon us to share, just so they know. Can I just ask one other question? Is there, can you share with us, is this maybe a local insurance agent that may provide coverage of policies? Is there a leading agent that would provide this coverage, or sort of focuses on flood insurance, or?
You've got a lot of really good, I mean, I've dealt with them for a long, long time. You get a lot of really great insurance agents in the greater Lowell area. And I can't, recommend one over the other, et cetera. But what I tell people is that if you're getting your homeowners an auto from an insurance agent, and you start asking them questions about flood insurance, and they act like, oh, I don't know anything about that. I could care less, et cetera, which unfortunately happens. I would grab my homeowners an auto, and I'd start going down the street to every other insurance agent and saying, if you can be a great agent for me, answer my questions on flood insurance, you get my homeowner's auto and my umbrella. And the minute that I tell people that, and they go back to their agent and say, well, maybe you can't answer my questions, I'm going to take all my business somewhere. Amazingly, the insurance agent all of a sudden has the answers.
Okay, and just the last follow-up. Should insurance, as of October 1st, for existing policy, should the insurance agents be making these adjustments, or does a homeowner have to ask, meaning, hey, I heard about this 2.0. Have you factored that into my new annual premium?
Yeah, they right now for the renewals that are coming up, an agent can be fairly passive because if somebody's going to have a higher premium on their renewal because of risk rating 2.0, they won't see it. They'll still stay with the legacy system premium. So they'll complain about, the usual rate increases that we're doing practically every year. But it's going to probably be when we get to the April 1st renewals where an insurance agent is going to have to, if somebody's premium goes up and we're showing, a full risk premium and a billable premium, and, they're going to get calls to say, when is the sword of Damocles going to fall on my head? It's showing, for instance, I have a preferred policy, it's $600.
Okay.
Motion to adjourn.
I think we lost Bob, but I think he answered your question
Yeah, I
environment.
did. No, it's fine.
Okay.
It's good.
Perfect.
Well,
Thank you very much.
Thank you, John and Bob and Dave and everyone from FEMA. On behalf of Congresswoman Trahan, thank you so much for spending time with us tonight, and I'm sure we'll be circling back with a couple of follow-up questions, but thank you very much.
Emily, please thank Congresswoman Tran for allowing you to make this presentation. Thank you. Motion to adjourn.
Good night. Thank you.
Second, thank you. Motion.
Thank you.